like that. Instead, we just chit chat. So, hello there. Welcome to another edition of Real Estate Revelations. I'm really excited about this week's edition because I did not know that this loan product still existed. It was something that many of my clients had used in the past, and now it seems to be back. So, welcome, John Klaess with CMG Financial. John, until I was talking to Aaron a few weeks ago, I was familiar with the old McCreary. I think they call it accelerator loans that they used to do. And now, tell me a little bit. Has the CMG brought that back, or how did CMG come to?
So so it used to be called so Macquarie. They used to have the asset manager loan, they called it, and CMG came out with it. Used to be called the Homeownership Accelerator. It's actually been out for a while, but then we have rebranded it called the All-in-One Loan. But it is basically just very similar, same product as Macquarie. Macquarie does not no longer have mortgage operations in the United States, so they are not. So we are the only ones doing it now, and it is called the All-in-One Loan.
So CMG Financial is the only place to do this loan in the country.
Right now, CMG Financial is the only place to do it in the country. We have a couple different banks that we use, but it's very specific. So, yeah, CMG Financial is the only one.
Awesome. Well, let me click on this PowerPoint. It's going to put our mugs down in the corner, and you can take it away.
Okay, Jude, I want to thank you for bringing me on today to kind of explain the loan. And for everybody out there, it's called the All-in-One Loan, and what we like to do is say it's the smarter way to borrow. What I want to do is kind of give you a little backdrop on CMG and how the loan works, and then we'll go through a simulator at the end of it, which is a great tool for people to use to find out how it can work for them. But like I said, the All-in-One Loan, we call it the smarter way to borrow. With the All-in-One, the CMG was established in 1993. Our headquarters in San Ramon, California. We're one of the nation's largest privately held mortgage banking firms. We are direct Fannie Mae, Freddie Mac seller and servicer and Ginnie Mae issues. So we do all different loans that we do. We do a lot of government or Fannie Mae loans. The All-in-One Loan is that is a proprietary product. It's like I said, we're the only ones doing it now. So it's not sold off to a bunch of different investors after you get it. We lend in all states, so we do all 50 states, but we do not lend the All-in-One Loan in all 50 states. So I just want to make sure that they can contact me, a list of states we do. We are in about 32 states right now, so most states we do. And again, if anybody wants to find out, they can contact you or me directly and find out.
Well, most importantly, you do it in Colorado, where I'm at and where you're at, correct?
Yes, Colorado is actually a very good state, very big state for it, and we do it in Colorado. Yes, so awesome. We can kind of get past that. We introduced like I said, the All-in-One Loan in 2005. It was actually called the Homeownership Accelerator back then, but it did come in, and it's been featured in Business Times, Money, and CNN Money on a way to do it. On here. So the All-in-One's loan purpose is mainly to help borrowers avoid tens, if not hundreds of $1,000s in mortgage interest cost. A little bit about mortgage. 30-year mortgages were created during the Great Depression. So 30-year and 15-year mortgages were introduced. These instruments intended to help spark the U.S. economy, and the 30-year mortgage has been the gold standard for 90% of Americans how they finance their homes. But it doesn't come without a cost, because the 30-year mortgage was created, for people to be able to afford the monthly payments in their home. It wasn't the best thing as far as interest cost goes.
Right.
30-year mortgage. So U.S. mortgage debt, we're about over $10 trillion in debts, in mortgage debt. So mortgages is one of the leading, for the banks and things go. It is one of the leading things that keep us in debt as far as things go. U.S. mortgage debt and its impact on households. A mortgage remains the single biggest personal expense any one American will commit themselves during their lifetime. Many households spend up to 50% of their disposable income on the monthly mortgage payment. Now that's kind of with the new ones. 50% is kind of the DTI, but most people are, savings is very little because it's going to pay mortgage debt, and then the rest is to living expenses and savings. And so
Right.
what we're going to kind of show you here is a product that can help kind of reverse some of that interest cost and how much it costs you to obtain that house.
Well, that's particularly true across the entire country, but here in Colorado, where housing prices continue to increase and maybe wages are a little bit stagnant or not increasing quite as much as the appreciation in houses.
That is correct. Yeah. So it's taken up more and more of their income. And like I said, it usually eats up about 50%, if not more, of some person's disposable or monthly income. The U.S. mortgage, debt and impact on a household. So much of the mortgage is interest. And so whenever you do a mortgage and you see what the total cost of that mortgage is, most people disregard that and they just really focus on what the monthly payment is. And they're not focused on what their total interest cost is. And that's what can really impact somebody's retirement later on. So for example, in this example, $300,000 loan at 4% over 30 years, you're going to end up you pay the $300,000, but you're also going to pay $215,610 of interest cost on that. And that's at a very good interest rate. And that's actually, if you really add it up, and this is kind of what the mortgage industry has done just recently with some of the new laws, is it actually shows people the percentage. We show this 71% of the principal is going to interest. So it's actually, you're paying 71% of interest cost on that loan over a 30-year period. And that's what we hope with the all-in-one loan people start looking at, is how much did it really cost me for that house? But it's a pretty staggering figure because with the banks, they're collecting all their interest up front.
Well, and it benefits the banks not to market the fact that 71% of that is paid towards interest because they make more money, correct?
They make more money, and the thing about it with theirs, and one we'll show you with the all-in-one loan, is they're collecting all their interest first. So
Yep.
their risk factor goes way down because you don't start paying principal for quite a while in a regular amortized 30-year mortgage and even a 15-year mortgage.
Right. So would you say that the 30-year mortgage has become the gold standard just because that's benefiting those who lend the money?
Well, and don't get me wrong, yes. So that's why it's been, so there's very few other spaces that something was created, back in the 1930s that hasn't been approved upon. Really, the 30-year mortgage was created back then, has not really changed since then. And with it being 10 trillions in mortgage-backed securities, the banks, they want to keep you there and kind of keep you in that. But I will say for the right 30-year mortgage was a good thing for putting very little money down and letting people be able to afford the monthly payment.
Sure.
So 30-year mortgage is good things, but it's not like in Colorado. If you gained equity in your property or appreciation in your property, where you might have put in 5 or 10% down, but now you have 20% equity, that is the time when you want to really look and look at other options. When you're only putting 3 or 5% down, you don't have a lot of options. But if you gained, the Colorado real estate, the appreciation here has been very strong in the last couple of years. So for people that have gained that give that 20% equity, yes, they should start looking at other ways.
Right. So it could be great to get into something, but stay in touch with your lender so that you can find better options and save literally hundreds of thousands of dollars. That was my promo on this on Facebook, but you can literally save hundreds of thousands of dollars, which I don't know about you, but I'm all right with saving 100,000. I'm all right with saving hundreds of dollars, let alone hundreds of thousands of dollars.
Well, it can change somebody's retirement greatly,
Yeah.
when you go through that. So it really is something you should look at. So conventional mortgage, like we were just talking about, what it does, it impedes the progress for your other financial goals, such because you're paying so much towards interest costs. So really, in a 30-year mortgage, your payment goes to interest first, and right there, it takes 12 to 13 years before the monthly payment converts to paying more principal than interest. So the first 12 or 13 years, you're actually paying more interest than you are in principal. And it really takes 22 to 23 years before the principal actually catches up to the amount of interest you paid. So as you can make extra payments and things to help lower that cost, that only helps you at the back end. It doesn't help you during that first 7, 8, 10, 12 years. And that's where the banks have you really. The 30-year mortgage has people confused because on average, people also tend to refinance every 3 to 5 years. Mm-hmm. So you've really haven't paid anything towards that principal. All you've done is give the banks their interest. They've collected interest and protected it. And that's where the all-in-one loan, we'll see a slide here, but we pay principal first and not interest. And that's one of the great things about it. But it's pretty staggering if you see after, and we'll go through it in the simulator, but after a 5-year period, how much principal you've paid down in a conventional mortgage compared to the all-in-one loan.
Awesome.
Obviously, one of the things we like for people to look at this all-in-one is because of the retirement crisis in the U.S. Where we are, right now, it's the baby boomers and where we're at now, the companies don't give pensions anymore. So you have to create your own pensions or your own retirements, and you don't want to just rely on Social Security. So this is something where, you can really gears it towards helping you time out your retirement to where you have your house paid off and you've saved, and you're able to take that interest cost that you've saved with a mortgage and possibly put it into some other retirement products. So it's one of the things that can really help with the retirement crisis that we're in. Wouldn't you prefer to retain more of your income? Other future financial considerations. A lot of people, college tuition, increase in healthcare costs, preparing for emergencies. With a 30-year mortgage and you're tied into that, you don't have the option of using some of that unless you refinance and take some of that equity. Where the all-in-one loan, you can have access to that. Borrowers with the all-in-one loan have proven to, and this is a study we did over several thousand loans that we've done, but the borrowers with the all-in-one loan, and these are actual data, they allocated 3% more of their earning towards retirement savings. They allocated 17% more towards cash reserves accounts, emergency accounts. They avoided paying tens and thousands, $100,000 in interest costs. And one of the biggest things is they've lowered their principal balance by up to 12% per year.
Wow.
Yeah, if you think about it, and if you have a $400,000 loan and you're paying it down by 12% a year, that's $50,000 that you've paid, or $48,000 you've paid towards your principal, to where in a conventional mortgage, you've maybe paid 2 or 3% down towards that.
That's a huge difference.
That is one of the biggest things that people, this loan, which I do love. It saves you $100,000, but it's how much principal you pay down on the loan. So they're able to use their home equity dollars for unplanned expenses also without having to refinance. It's something that if somebody loses his job, you may not be able to refinance. You may not be able to qualify to get your home equity. Your only choice is to sell your home. Well, with the AIO loan, you can actually absorb those because you've paid so much principal down. You can absorb those times where it takes you to find another job or done that because you have use and control of those of that home equity that you've paid down, which is a wonderful tool.
So to the other beautiful part there's many beautiful parts, but the other beautiful part, other than saving potentially hundreds of thousands of dollars, that you have the access to that equity, like immediately. You're not having to refinance. You're not having to go through the process. You're not having to jump through a lot of hoops. You've got access immediately to that equity.
Correct. So, for example, you've paid your loan balance down by 12% a year. So let's just say you've paid it down by $50,000. Well, you have access to that $50,000 for anything you want, any control, anything you need it for. So as you want to pay down your house, it's also the use and control. And you may need that money for college tuition, or you can use that for emergencies, healthcare costs, or loss of a job. So yes, you have access to that. And that's one of the great features of this.
Yeah, that is awesome.
So one of the things is, what is the all-in-one loan? So there's 3 key features in the all-in-one. one of the things at first and why it pays the principal down. So it applies, all payments go towards principal first. Unlike a traditional amortized loan where it takes interest, everything goes towards principal fund. It computes your monthly interest on a nightly after the principal balance has been lowered. So as all payments go to your principal balance, it helps you lower that total interest cost at the end of the day. And it provides personal banking features and access. So it's a home loan that works just like your bank account. You have an ATM debit card, you get checks, you get online bill pay, ACH transfers. It's an account just like you're doing with your checking account now, which we'll talk to in a little bit on, the only real use of a checking account is the use and control. It's not the interest or what the banks pay you on that checking account.
Right. Somewhere to store your money.
So where to store your money because then. So why does it make sense for the all-in-one loan? Because one of the biggest resources in your life, so use your checking account. There'll probably be, if somebody realizes there'll be more money in their lifetime will pass through their checking account, whether it stays there or not, but it passes through your checking account than any other resource in your life. So the money is always getting back. And the banks pay you, you might get, 0.5% on it, 0.10% on it, but the banks are not really paying you on it. It's just a place to kind of store your money. And again, it's probably where there's more money in your lifetime goes through your checking account than any other place. Why does it make sense? Because what it does, and then what you have is you have one of your biggest costs in life. You have what's your mortgage payment. So your mortgage interest. We like to call this is your checking account is your pile and your mortgage is your hole. And what you're doing is, and if you have a 4% mortgage, you're paying 4% interest on that mortgage and you're paying it on the balance. So if you borrow $400,000 at 4%, you're paying 4% of $400,000 for the life of that loan, not on the balance you put down. So one of the biggest cost in your life is your mortgage, and that kind of work. It kind of takes a lot of your money. Like we said, over 50% of your income goes to the mortgage. So what we're doing is why the all-in-one makes loan is because your income, as it comes in, why it's sitting to your bank account now, not doing anything. What the all-in-one does, it moves that money straight over and it drops it against the principal balance, which lowers that interest cost that you're paying on that mortgage. So right away, you're basically saving interest, and saving interest is the same as earning interest. So you're still yielding. So that's one of the great features is the income or the money you put in your checking account is always working for you.
So as soon as that income goes in, it lowers that principal balance, which means you're paying less money on that loan. And it does it, if I recall from that previous slide, you said it does it nightly. So we're not waiting until the end of the month to calculate all this. You're saving immediately.
It does it nightly, and it does an automatic sweep, so you don't have to go in there and tell it to do it or worry about moving it. It automatically does it, and the great thing about it, if you write a check, go use your ATM just like any other checking account, it'll pull it across. But what it doesn't do, we call it a zero balance checking account because what it doesn't do, it doesn't let that money just sit in your checking account and not do anything for you.
Right.
Which is so your money's always working for you. And it's your money. You should work it. I mean, the bank's taking your deposits and they're lending it out to somebody else for like 7%. So this is kind of reverses that, and you can use that money for yourself to save you interest. And on a nightly basis, it has a great compounding effect on it.
Yeah, that's phenomenal.
So savings on the loan works is savings is accumulated on a daily and compounded monthly through normal deposits and withdrawals. So, for example, you have a loan balance, and let's just say loan balance of $300,000. Say on the first of the month, you deposit $5,000 in there. Well, what it'll do is at the end of that business day, that $5,000 will go against that $300 and drop it to $295. You'll be charged interest on $295 for that day. And then what it does during the month, your balance will start going up, and that you may be a week before you have to spend say $1,000 in bills. So that $295, say you spend, it goes by a week, and then it goes up to $296, and you only pay interest on $296. And then let's say another 2-3 days go by, and you have to spend another $1,000, goes to $297. And then the 15th of the month, if you deposit another 5,000, goes down to 292. So it's really calculating that interest on a daily basis, and why that money sits in your account. It's saving you interest. It's basically earning you interest. So it's another feature that we teach when we do these is timing your bills out to pay towards the end of the month, and you let that money sit in your account longer,
right?
Which is great over. So that money's always sitting there, leftover equity, and it's always available to you there. So it's one of the great features on that, and the total interest for each previous month is taken out about the 20th of the month. So it's one of that's kind of how it works. So some of the all-in-one features comes with, it's a 30-year, it's an actually 30-year line of credit. So you actually have access to, it's probably one of the only ones I know of that is actually a 30-year true 30-year line of credit. You do get debit cards with it. You get checks, online bill pay, complete just like any banking account now. You can do ACH, bank to bank transfers. It's FDIC insured. It's one of you get online statements, you get monthly statements mailed to you. We have a great 800 department that's geared just towards AIO clients. But it's one of those things where it's really no difference. The great thing about the AIO loan, we're not asking you to do anything differently than you're doing now. It's just how that money and where it sits. We're not sitting there saying you need to spend less or save more. It's actually doing with what you have now, and that's how it pays it down on itself. So it's one of the great features of the all-in-one loan. So what we're going to do, go ahead.
John, before we get into that, why in the world would anybody choose another way to borrow?
Well, what I always say, but I'm probably a little biased, but if you qualify, it's the greatest loan on the planet. I really do believe that. So it is a great loan. There are some features that we're going to go through on the simulator here next, but it's one of those. It's one of the things that you have to make sure it works for you as far as what your monthly income and expenses are. But if you can qualify, it's truly one of the best loans on the planet.
So as long as you're spending less than you're taking in, it's probably the best loan you could possibly get.
That is correct. It's saving. It's really taking what your average daily balance in your checking account and making it work for you.
Now, the only thing would just be kind of changing your thought process around how you're depositing your money and how you're spending your money out of an account like this as opposed to a checking account, right?
Well, it really operates just like a checking account. So you don't really need to think about that. What you'll do is you'll start spending a little differently on savings and stuff. Mm-hmm. But truly, the difference is that, and we'll go through it here in a little bit, but there's a portion of the loan that's an adjustable rate, but that's what makes it so effective, and that effective interest rate. So really what it is, it's a simple interest loan compared to an amortized interest loan. Okay. And again, I would tell everybody out there to really think about or look at your truth in lending statement and how much money are you actually paying. I mean, There's probably no other place in your financial life to where you would pay $216,000 of interest to borrow $300,000 except for a mortgage. So it's reversing. You got to reverse your thinking to where it's not just about the monthly payment; it's about the interest cost.
Yeah.
So what we're going to do here, I believe I'm going to do the screen share. And can you?
Yep. I'll stop there.
No. Yes.
So we're going to get into a simulator now, where you're going to show us actually in hard numbers how much somebody can save on a potential loan, correct?
Correct.
Mm-hmm. Awesome.
So let me know when you can see my screen. Okay, you should be able to see my screen now. Is that correct?
Yep.
Okay.
That is correct.
what we're going to do, and kind of you can stop me anytime you have some questions and things, but here is the simulator site. And actually,
yeah. John, let me just point out anybody watching here, if they've got questions or specific questions, we got several people, Steve, Josh, Dennis, Dean, they're all kind of watching and going through this. If you have questions specifically for us, feel free to type into the comment section. I'm monitoring this, and we can stop and give you some answers and some more specifics around any of your questions.
Okay, so now what I'm going to do is I'm going to go to this AIOloan.com site, and this site is a public site, so anybody can go to it. We have several videos on there, but more important, I'm going to show you how to work through the simulator. So when we go here, we're going to hit Get Started, and then we're going to hit Get Started again. And this is where we're going to add some of our own, and I'm going to just do a sample one here, and I'm going to say we're going to do it on a loan, and I'm going to estimate the value at $500,000, and I am going to compare it against a 30-year fixed mortgage. Let's say somebody owes $380,000, okay, and I'm going to compare it against a loan that has an interest rate of 4.25%. And right down here, it will show you actually what the principal and interest, because what we do is we just use the principal and interest payment now, and it will give you a hint down here. So I'm going to go ahead and type in 1869, and that's what you would do. And if you put your numbers in, it'll tell you kind of what that hint is there. And then I'm going to go down, and we're going to, if you had a second mortgage, you would just click on here, and we could put in the second mortgage here, but we're going to keep it simple for right now and compare it against a $380,000 loan. The next screen, when we go over there, we'll get into deposits. Now, when we're in deposits on here, we want to know kind of what your net deposits are, because what we want to, what this simulator is designed to do is how much money flows through your checking account. So you can do it, have you get paid weekly, bi-weekly, semi-monthly, monthly. Numbers don't change too much if you do it monthly or bi-weekly. It does add it. But, I'm going to go ahead and add some numbers here. Jude, did you have a comment here? Or?
No.
Okay, so net deposits, and I'm just going to kind of put up some numbers here. And let's say there's one spouse that makes on a monthly basis $5,800 on a monthly basis after taxes. And I'm going to put in here, and let's put in $2,800 for another spouse. And like I said, we can use this as monthly, or you can change it to bi-weekly, any of those things you want here. Add another would be as if you had some other incomes, if you had rental income, different things you could add on here. Future lump sum deposits, whereas we're not going to use anything now. This is a great tool because what it would do, it would show you if you have $20,000 sitting in a money market account not doing anything for you, well, it would make sense to move it into that account because it's going to lower it right away, but you still have access to it. So if you have some money sitting in accounts that aren't making you, 4 or 5%, it's smart to move them over here. So the simulator has some great features that you can go through.
That's a great point, John, too, because the money markets, you have to determine, is the money market account going to make you more than the appreciation that you're going to have in the property in the duration of that money market. And the way things are appreciating now, it would seem to me that generally you could safely say, let's put it in the all-in-one for now.
You put it in all-in-one even with the monthly interest, because you could actually take whatever your 30-year mortgage interest is, and that's basically what your earnings,
that
like
too,
you said,
right.
Savings is just like earning interest, so it's a yield. So that's one of the great features about it. Right. So I'm going to continue, and the next one will be the expense page. And as you can click here, and you can actually get very detailed in your expense. We've actually built a expense model, which is kind of nice. And you go down here, and I'm going to put in a percentage here, but I'm going to put in 20%. And so as we read over here, this shows monthly deposits of $8,600. It shows outflow or expenses of basically $6,900 a month. So, I'm using some pretty, aggressive numbers here, and you can do that, but it's showing your expenses here. Again, your monthly expenses and your mortgage. So your total expenses would be about $6,900. So there's about $17.20 that sits in your checking account on an average daily balance. And so what we go in here, and what you can do is here is also, as you can add in the future lump sum deposit, you can also take withdrawals. So, a lot of self-employed people, they'll keep their taxes until they have to pay them. And this is a great way to keep them. I've had a lot of financial planners and things that'll keep their quarterly tax payments in this account until they have to pay them.
That's a great idea.
So what we do here is we'll come up to the results page. And it should come up here fairly soon. And so what we do is we kind of shows you how it compares. And so we have the all-in-one loan here on the left. So just by using the all-in-one loan, your total payments are $536. Your years to pay off are 12.4 years compared to 30 years. And your interest saved is $136,322.
Wow. So I'm paying off my loan in less than half the time and saving over $100,000.
Yes, and that's fantastic. Yeah,
that's unbelievable.
So some of the things I'm going to go down through here, I'm going to scroll down to the bottom real quick. And what this interest rate assumptions are, this loan margin value, we offer it in 3 values, but we don't charge an origination fee. And if you do 3.5%, that's usually what we'll kind of default to. And you'll be able to see up here as it actually went down to where your monthly savings is $146,000. And some of the things I'm going to point out here is the principal reduction. So you're paying down your mortgage in this scenario, 8.2% per year. Like I said, on average, our clients are paying about 12% down per year, but that's compared to a 30-year fixed mortgage of 3.3%. Your interest paid, and this is where you're saving that interest cost, and this interest as a percentage of principal. So this is where it really is kind of you're paying 77% in a 30-year fixed as a percentage of your interest cost, where here it's down here. Your effective rate with this loan is 2.3%. What that means is you'd have to have a 2.3% 30-year fixed rate to pay the same amount of interest. With the scenario of the income things that I showed you there. So there's one other thing I'm going to show you, and then it's kind of going to be kind of more of, if people want to learn more about it, is to contact either you or me directly, and we kind of run through their scenarios. But I wanted to show where we have this repayment schedule, and what I'm going to do is kind of show what I was talking about before, is after like the 3-year mark, how much farther you're ahead with this loan compared to a 30-year fixed loan. So if I scroll down to right here where it's 3 years right here, or right here after 2, let me go down to right here is after the 36th month. So let me just go down here. So if we go here to the 36th month, which is 3 years, and if we go here to all-in-one loan, you've paid down $72,000 and your balance is only $307 in interest. So you've paid it down there. So that $307 compared to a 30-year fixed mortgage where you still owe $359.
Wow.
So you've done, you've reversed about $50,000 just after 3 years. So that's where the effect of paying principal first helps so greatly compared to a 30-year fixed loan. Is your balance your principal balance. So just kind of wanted to point that out, and people can kind of look at that and contact to get into more specifics about that. But those are kind of that's just the simulator I wanted to show real quick. So I'm going to go ahead and log out of that unless anybody has any questions, or you have any questions as far as the simulator goes.
No, but I've got a couple of questions. So as far as qualifying, is there any different qualifying criteria? Is there anything specific that they need to qualify?
Yeah, so what we do is the qualifying is we do 80. We'll do it on refinances or purchase. It's a great purchase loan, but we'll do it up to 80% loan to value. So you have to have 20% equity. And then we have a minimum credit score of 700 right now. Which that may go down to 680, but right now it's 700. And then we require 10% in assets, but the assets don't have to be liquid. So, for example, if you did a loan for 380, you'd have to have 38,000 in a 401k, retirement, any type of assets in a money market account or something there where you don't have to touch it, but we just have to show it. So those are really the qualifications. And then we do a debt to income analysis, but those are just like a Fannie Mae or Freddie Mac type loan, regular loan.
Okay, so there's going to be some back end ratios, 50%, 45, somewhere in the general range that most loans go.
Yes. We actually go off of Fannie Mae, Freddie Mac guidelines on that. Yes.
Okay. And then the website, if anybody wanted to compare what they're doing now with what they could get from CMG Financial with the AIO loan, is it AIOloan.com?
That is AIloan.com. That is correct. Yes.
Awesome. Great. And then lastly, if anybody needs to get a hold of you, was there anything else you were going to run through on the loan?
No, I'm done with showing the simulator. Like I said, if people want to call and go through more specifics, I'd love to do that. But where can
they get a hold of you, John, if they want to call you?
If you want to call me, they can reach me at 303-577-7206. My email address is jklaess, JKLAESS @cmgfi.com. And yes, I would recommend just reaching out to my local number here, the 303-577-7206.
Okay. And lastly, what is your NMLS number, John?
My NMLS number is 271003. And I am licensed in about, as this is Colorado, I am licensed in about 30 states that we do the all-in-one loan in. And I do a lot of the all-in-one loans. So any questions I'd love to answer on. Yes.
Awesome. So I'm going to ask anybody if they found value in what we've shared today. I mean, this is absolutely phenomenal and exciting, and I encourage everybody to at least go to AIOloan.com and kind of run a scenario if you own a home to see how much money you could potentially be saving. But share this on your Facebook page, please. Go to my YouTube channel. Subscribe there. You can rewatch this. You can share this with your friends and send links as well. And help them save hundreds of thousands of dollars. Seriously, how good a friend would you be, right, John, if you sent them a link that saved them $100,000, in the next 12 years? I think you'd be pretty, you're definitely gonna get on a Christmas card list at least, right? I would. And
we're not asking them to change anything that they're doing today. We're not asking them to go make more money or save more money.
Exactly. You could definitely be a hero. So if anybody watching this replay has questions, there's a comment box that you can fill out, and it'll send an email to me directly. If I don't have the answer, I'll get you in touch with John and answer any questions that you might have about the AIO loan. There we go. Now we can see us again.
Sorry about that. Yeah.
And it's CMG Financial and John Klaess. Give us your number and your email just one last time.
The phone number is 303-577-7206. The email is jklaess@cmgfi.com. That's JKLAESS @cmgfi.com.
Awesome.
And
John, thanks. I'm sorry. Go ahead.
I want to say thank you. Thank you for sponsoring this and putting this on today.
No, my pleasure. This is a phenomenal product that could save people. There's innumerable things that you could say about how much, what a great impact and how much it could help people and families if they looked into it. And I encourage everybody to at least look at it and give you a call. So thanks, John. I appreciate it.
Okay. I'll see you later, Jude.
Thank you. Soon.
Okay, bye.